First, I just want to get your take on some of the action that we're seeing in the currency market, specifically with the dollar. We just pointed out down about 4% since the tariffs were announced, and also just the volatility in the bond market.
Yeah, great. I think last week it was more a reflection of noise rather than signal in the bond markets, because there could have been some technical factors like the unwinding of the basis trade, some Japanese selling, but also maybe tax payments due. What is interesting is despite the equity market rebound, the dollar continues to sell off. And I think that's an indication of the time to come in the future. I think once this dust settles, will you really want to own 65% of US equities, which is the weight of the US market in the overall global indices, or would you want to get some capital out? And I think the current move is a reflection of that. Dollar already started from an expensive position, and there is some lack of confidence in the growth trajectory here and the monetary and fiscal policy, which is getting better globally.
Speaking of that lack of confidence, we're getting some new data from the Bank of America Fund Manager Survey. I just want to bounce some of this off of you. Record number of global investors say they intend to reduce their allocation to U.S. stocks. That's one big bullet point there. 49% of respondents say their long gold, most crowded trade right now, also ends a 24-month streak of long Mag 7. A lot of this has to do with what we were just talking about, bond yield volatility, the dollar moving down. When you're seeing this setup right now, is there a more attractive place to put money if you're an equity investor outside the U.S., or is there just potential to buy the dip here? We're hearing a lot of people think that we may be close to a bottom. There may be a bounce underway right now.
I think there is a case to be made for some allocation to move internationally. One is the dollar being the big driver of international equities. Secondly, I think the most important part is the growth trajectory and the growth differentials of the US versus the rest of the world. Tariffs are going to be a tax on domestic producers, on domestic consumers, and monetary and fiscal policy is looking much more attractive in other parts of the world. Central banks like India and Philippines recently cut rates. You have Europe that has an offset with the fiscal stimulus. So I think there are reasons to want to move internationally, both from a currency standpoint, but also from the monetary and fiscal stance that is more favorable in other pockets of the world.
All right. A lot of people are saying, look, outside the U.S. for opportunities, but let's say you're someone who wants to focus on the U.S. and look for opportunities here. Where would that be? Is it defensive sectors? Is it small caps that are generally more domestically focused? I mean, where would you go for opportunity?
Yeah, I think we have a mix in our portfolios. Of course, we do own only some pockets of Mega 7, but we are underweight relative to the benchmark, given that there is a lot of capex here. There's questioning of the returns of that capex. China had its DeepSeek moment, which kind of proved that there is some commoditization happening in that AI space. Industrial pockets, financial pockets in the US look good. Of course, it's important to also be in defensive sectors now, but you have to be really discerning because the tariffs have been imposed across the whole spectrum of products. But with the collateral damage that's happening in the market, we do find opportunities that are scattered across. I'd say also building some defensive positions at this stage makes sense.
We have to go, Jitania, but very quickly, I want to get specific. When you say defensive positions, is that gold? I mean, it seems like a lot of people are piling in gold, or are there actually parts of the equity market like staples or utilities? Are those defensive right now?
Yes, so pockets of staples, but again, you have to be cautious where the tariffs have been imposed. Even some industrial pockets, we like the defense space. It's important to also understand what's happening in the healthcare space. It's a hanging sword with the tariffs there, but those are some other defensive pockets in the market. There are stock-specific opportunities that are emerging with this correction.